Emerging markets the world over had a torrid 2013 as global investors headed for the exit at the mere mention of tapering. Joining me to discuss what happens next is Mark Mobius, Executive Chairman of Templeton Emerging Markets. Mark Mobius, thanks for joining us. Just the talk of tapering was enough to send emerging markets into a tailspin last year. Now that we actually have tapering, is all the bad news priced in?
Yes, but I think the tapering story was overdone, frankly. I don't think tapering is significant in money terms. And the reason why I say that is that central banks around the world, not only the US, have been expanding their balance sheets tremendously. And people will say, well, where is this money? Well, some of it has gone into the stock market. You can see the US market has performed very well. A lot of it has gone right back into central bank bonds. Gradually, this money will be distributed into the economies, which is why I'm now very confident that 2014 will do very, very well.
Of course, it's not all about the Fed. Growth has also been a bit of a concern. Can you see these markets performing in an environment where growth is slowing?
What we've seen is this move into US assets, into Japanese assets. Eventually, and it's even happening now, many of these large investors, institutional investors, are overweight US and to some extent Japan, less so in Japan, but usually they're into the US in an overweight position. What do they have to do? They have to diversify. Where do they diversify? Global stocks. Which global stocks are the most attractive? Emerging markets.
Debt levels have also gone up across Asia. In some places it's household debt, other places corporate debt. Is that a major source of concern for you?
Not so much as you imagine, because if you look at the debt in relationship to GDP, emerging countries' debt to GDP is much, much lower than developed countries. The gap is incredible. So there's a lot that can be done in terms of revving up debt in emerging countries, provided that there are enough resources available and enough banks willing to give that debt. And you're seeing more and more of this taking place.
Aside from economics, politics is also increasingly on investors' radar. We've got elections this year in Indonesia, India, and now Thailand. What do you think that means for the investment outlook?
Lots of uncertainty, lots of fear. For example, in Indonesia, if you don't get a fighter for a reduction of corruption, then of course the market will not do as well as we would expect. In Thailand, if you have continuing uncertainty, the market will not do very well. Same thing with India. If you don't get a reformer in place, then the market will not do very well, at least in the short term.
Looking at things from a longer term perspective, looking backwards, for the last 3 years emerging markets have underperformed developed markets. Why do you think that is, and do you think we need a catalyst for that to change?
Well, if you look at it on an individual year basis, you must remember over the last 10 years, there have only been 3 years when emerging markets underperformed. Last year, emerging markets underperformed, but the year before it outperformed. This year, we expect emerging markets to probably come back again and outperform, simply because of the numbers. The economic growth numbers are so much better.
Mark Mobius, thank you very much.
Thank you.
And there's plenty more on all things emerging markets at ft.com/beyondbricks.